Tom, do you think this puts some of the big concerns that were surrounding some of the big banks to rest, given what we got out of Citi today? Or does it raise more questions?
Well, I thought it was a great report by Citi in the sense that they did an outstanding job all year long on expense control. And the environment that they had to work with in the fourth quarter was terrible for trading, as you mentioned, and yet they were still able to lower their efficiency ratio for the 9th consecutive quarter. So I think what it says is that the bank stocks were oversold in the fourth quarter. Citi was down about 30%, and the expectations just got so negative that they exceeded those negative expectations.
Tom, do you think that cost-cutting, expense control will be repeated by the other names, or was that stock-specific? Excuse me.
Well, Wilfred, I think you're getting to a really good point, which is in 2018, I think the 4 largest banks, so I'm excluding Goldman Sachs and Morgan Stanley from this discussion, but they got to the point now where the costs of running the business are going down because of efficiencies, and they're able to take some of those savings and fund their investments. So there's been this crossover point where the prior year's investments are actually leading to lowering the cost of actually operating the business. So yes, I do think it will be followed by other banks.
Dick, do you think the main thing we're seeing today with all of the banks trading higher was just how cheap they'd become coming into earnings?
Right. Well, as you know, in 2018, bank stocks were down 18%, while the overall market was down only 6%. And this is despite the fact that the dividend yields on banks is about 30 to 50% higher than the market, and yet their PE ratios are about 30% lower than the market. So if you're a value investor, this is a good time. And I fully expect that bank earnings in the fourth quarter will be much, much better than what the recent stock prices suggest they will be.
Your old company reports tomorrow morning, Dick, and clearly it doesn't have big exposure to the fixed income commodities and currencies trading in the way that some of the other banks do, which was an area of weakness for Citi. So are you encouraged that they should have a very strong set of numbers tomorrow?
Well, I think they have other issues, and I think despite those issues, their profits have been reasonably okay. But I think until those other issues are solved, they're not likely to have great earnings increases, but still do reasonably well. I think that, in my opinion, market-sensitive revenue, it goes up and down. To me, it's in any given quarter, it's irrelevant. And I think the rest of the banks and the rest of the areas of which they do business will be reasonably strong, and with more efficiency, the profits will be much better than is expected by the market.
Tom, a bigger picture, I wonder how you're thinking about how the larger banks ought to be valued, either at this point in the cycle or just in general. A few years ago it was saying, well, regulation meant that they're kind of utilities, financial utilities, but without dividends. Now maybe they're financial utilities with dividends, with some kind of economic leverage, but 9–10% returns on equity, is that worth paying up for at this stage? Well,
among the largest banks, that would be the lowest return on equity that we'd be talking about. So Citi just barely made 10% return on, 11% return on equity in 2018. Their goal is 12% for next year. But you're going to have other of the large banks are going to report 15% return on tangible equity. So as I look at the business, I don't see anything as a utility. I see a business in a remarkable transition, and particularly the largest banks are winning in the retail banking business.
In the long term, Dick, do you think that these banks would be well priced regardless of what the economic outcome is? Clearly this morning, Citi did suggest that we're not heading to a recession, but do you think because the last recession was so focused on banks that people and investors are pricing in something more cataclysmic as a risk going forward?
I think that's possible. I think there's just a lot of things that are uncertain, and banks are involved with every aspect of the economy. When you have uncertain areas, trade and Federal Reserve policies and so on, it just causes people to wait. And I think when they see the earnings, when they see the fact that credit quality is very good, the efficiencies are improving, and because they've just been beaten down so badly, I think all of the negatives in the banking area has already been built into the prices. I mean, again, 30% below the market and 18% fall last year. So they're at a level today where I think any good news is going to result in higher stock prices.